Hello, my name is Alicia Kramer, and I'm the Senior Vice President for the U.S. Endowment for Forestry and Communities. And I would like to welcome everyone today to our meeting, which we will be addressing investment trends in ESG and SEC reporting. The U.S. Endowment for Forestry and Communities and the New York University Stern Center for Sustainable Business are honored to host this panel and want to thank you for taking the time to join us today. We may have a few more attendees popping in, but we're going to go ahead and get started today. And recently, at the request of industry, the endowment has facilitated the formation of a Forest and Wood Products Inclusion Council, which is coming together to explore ways to address racial and gender inequities and promote diversity, equity, and inclusion within our sectors. For our sector, these issues often intersect with climate and sustainability issues, particularly with vulnerable communities and forest-reliant communities. Creating a better understanding of the way investors view ESG is important to our goals moving forward. The Inclusion Council is a 17-member leadership group whose vision is to have the sector reflect the diverse makeup of our society while committing to equitable workplaces so people feel valued, safe, and that they belong. The topic of today's webinar was identified by this council as a specific education and information need for our sectors. Existing trends in ESG and new SEC reporting conversations are impacting all companies within our sectors and certainly the end users we support. And our hope is that making this session available to all who wish to attend will have a profound benefit on our shared understanding and impact. I would like to thank the Inclusion Council members for advocating for today's meeting, thank our panelists and our moderator for taking the time to share their insights and their thoughts, and thank you all for participating in this event. We hope you will find it helpful, and without further ado, I would like to turn this over to Tansy Whelan, Clinical Professor for Business and Society at the New York University Stern School of Business.
Thank you so much, Alicia. It's a real pleasure to be with you and the attendees today. I'm really enthusiastic about our panelists. So I am a professor at NYU Stern. I founded and run the Center for Sustainable Business there. Our goal and mission is to help current and future business leaders embed sustainability core to business strategy to drive better performance, both financially and from a societal perspective. That's just a little bit about me. Our panelists include Sophie Beckham, VP and Chief Sustainability Officer at International Paper, Casey Clark, President and Chief Investment Officer at Rockefeller Asset Management, Beatriz da Cunha, Chief Operating Officer of BlackRock's Sustainable Investing Group, and June Yearwood, who is Managing Director, Natural Resources, Infrastructure, Low Correlation Strategies at the Church Pension Group, Church Pension Fund, which is an institutional investor. Both Casey and Beatriz are with asset managers. I just want to check, Deli, if, because I am seeing Alicia here, but not the rest of the team members pinned. So I just want to make sure that we're lined up in terms of having me, are people seeing me when I'm speaking? Yes, okay, good. Because I just see you, Alicia, but that's wonderful. Great, so I'm going to spend just a few minutes sort of giving a little bit of background around what's happening out there in the ESG investing space, and then we'll go to our terrific panelists. So today, globally, there's about $35 trillion invested in some form of environmental social governance investing, up from about 30 trillion in 2018. There's about 17 trillion in the United States, which is about one in every $3 invested. So really significant. Now, within that, there's a variety of different investing strategies, and that can be confusing, and it's important to understand the distinctions. So, for example, you can have negative screens, which is basically saying, I don't want coal or weapons in my portfolio. You can have positive ESG integration, which is looking at how are companies performing on material, environmental, and social and governance issues for their sector, and including that in your traditional financial analysis to have additional insight into the performance of companies. And then you can design your strategy based on how they perform. And then finally, there is impact, there's many different types of these, but I'm just sort of giving you the largest three groups. There's impact investing, which is explicitly aimed at investing in businesses whose purpose is to tackle a societal challenge, like, for example, a renewable energy company or an inclusive finance company. So important to understand those different distinctions. Um, One of the sort of very robust discussions right at this moment is around performance related to environmental, social, and governance investing. And we'll hear more about that, I'm sure, from our panelists. But I'd like to share a little bit of research that we've been doing around this. So we undertook a meta-analysis looking at more than 1,000 academic studies that looked at the correlation between ESG and corporate financial performance and investment performance that were issued between 2015 and 2020. This was actually in partnership with Casey and the Rockefeller Group. And what we found in that research is that 58% of the studies demonstrated a positive correlation between good ESG performance and corporate financial performance, and 33% of the studies found that ESG investing outperformed conventional investing. Only about, on the corporate side, 8% of the studies found a negative correlation. On the investor side, about 14% found a negative correlation. However, and when you look at sort of Morningstar tracking ESG performance over the last 5 years, the sort of sustainability leaders have outperformed the conventional over the last 5 years. That has changed in the last 6 months because a lot of this ESG investment portfolios have focused on reducing exposure to fossil fuels and also been overweight in tech. And so, as you might guess, in the last 6 months, there's been some changes there. But and we'll see ongoing, sort of shifts. But the fundamentals of sustainability and ESG really are about good management. And we've been looking at that at Stern Center for Sustainable Business, looking at what we call the return on sustainability investment at a corporate level. And what we're seeing is that embedding sustainability core to your business strategy is driving more innovation, more operational efficiency, risk mitigation, employee engagement and retention, customer loyalty, supplier resiliency, a whole series of positive benefits that support the better performance of the company. So on the sales and marketing side, and this is relevant for forest products industry, we do research each year on consumer purchasing in the consumer packaged goods space of sustainably marketed products. We work with IRI, which collects all of our barcode data at retail from all mom and pop shops to Target and Amazon, including e-commerce. We look at 300,000 SKUs each year across 36 of 40 categories, including things like diapers, paper towels, et cetera. What we see is that sustainably marketed products in CPG are responsible, and this is actual purchasing data, for 35% of the growth in CPG, and at a 30% premium on average. And last year in 2020, 1 out of every 2 new products introduced in CPG had sustainability attributes. And we also saw about $3.4 billion of carbon labeled products introduced for the first time. So we're seeing really significant consumer demand as one of these areas of benefit. In other areas, we also see, for example, how sustainability can drive operational efficiencies and innovation opportunities. So give you an example from a pulp and paper company was looking at reduction of water use. The mill managers, and this is in the US, the mill managers were saying, well, we don't really pay for water, so why should we worry about this? And what their analysis found is that the energy used in moving all that water around and heating and cooling it, and the amount of wastewater generated in terms of managing it, was costing the mill about $1.5 million per mill, per company, $1.5 million per mill in terms of that quote unquote free water, right? So understanding and embedding sustainability can really drive better financial performance. I'll give you one other example. This is out of the automotive sector and manufacturing. In working with a variety of different companies, we found that one company, through doing things like recycling paint and solvents, where you no longer have to buy the virgin stuff, you no longer have the waste disposal costs, and actually they were selling leftover solvent, recycled solvent, they were saving about $235 million annually. But because the CFO's office for all companies doesn't look at avoided cost, they weren't understanding the total value to the bottom line. So those are just to give you some, couple of concrete examples around how sustainability can drive better business performance, both on I've given you environmental examples, but we also see it on the social side. And the final point that I want to make is sort of around where we are on the standards, the sort of ESG reporting standards space. So as you know, we've had in the United States, the Sustainable Accounting Standards Board, which is mainly driven by investors, the Global Reporting Initiative, which is more multi-stakeholders, and then the TCFD, or the Task Force on Climate-Related Disclosure, used by investors as well. And now we've seen at the international level, the IFRS, in addition to their global regular accounting standard, is putting in place an international sustainable reporting standard. And working together with SASB and TCFD, for example, to design those metrics. One thing that it's important to understand about those ESG reporting metrics is that they are process and output based, not performance or outcome based. In other words, an apparel company under the SASB standards needs to tell us whether they have a chemical management policy or not. We don't really know whether that creates a performance benefit, but a company that has developed a bio-based dye that reduces water use, energy use, and no longer emits toxics and creates competitive advantage in terms of customer demand is very different. And yet the standards will treat those two things the same. So my advice to companies and investors is always, look at the KPIs associated with you managing for your material ESG issues, and then figure out how to map them to the reporting metrics. Don't manage by reporting metrics. That's your last step. So just a little bit of insight there. So now we're going to turn to our panelists and have a robust conversation around kind of their perspectives of what investors are looking for, particularly around the topics of climate and diversity, equity, and inclusion. But we will have opportunity to open up to other questions or all types of questions. So please feel free to drop your questions into the chat. And also, we'll come to the end of this discussion. We'll take those questions from the chat, but also if you feel like just using your voice, you're more than welcome to raise your hand at that point, and we'll call on you for your questions. Deli, is there a way for you to pin the speakers so I can see them? Because I can't at the moment, or maybe I'm just not looking at something correctly. I don't know.
It could be your view settings. They should be pinned for everybody.
Yeah, I'm just seeing the full gallery, but is everybody else seeing them pinned?
I also have the full gallery.
Yeah.
In your view settings, are you on to the top right when it says view? Are you on speaker or are you on gallery?
When I'm on speaker, I just see one speaker, and when I'm on gallery, I see everybody. I don't see anybody pinned. But go ahead.
Yeah, I can go ahead and unpin and then repin them and see if that does anything.
Great. We'll try one more time and then we'll get started. Sorry about this, everyone.
Tonzi, I'm using speaker view, and if you pull down the window a little bit, you should be able to see the pins at the top.
Yeah, I don't know. Not working for me, but that's okay. If everybody else can see all the speakers, that's all that I care about. So um, we will go ahead and get started. So again, we've got a terrific set of panelists for those of you who came in late. So Sophie Beckham from International Paper, Casey Clark from Rockefeller Asset Management, Beatriz Dacuna from BlackRock, and June Yearwood from Church Pension Fund. So let's start with a question to the asset managers and owners who we have here. I wonder if you could sort of introduce us to your company's focus on ESG investing, your thoughts on more broadly what's happening out there in the ESG investing world, and what you see as the next generation of investors looking for in a corporation's 10K filing or an annual report, right? So let me start. I'll kick this off and ask Casey, could you start us off on that?
Yeah, thank you. So I heard three things I'll hit on. Just our company's focus briefly, how the ESG world is changing, and then third, upcoming generation of investors. And I'll be under 5 minutes. So just starting with our company, Rockefeller Asset Management, we're part of a broader Rockefeller Capital Management. My division manages $13 billion in assets across equity, long only. We have hedge fund and fixed income strategies. Our core competency is sustainability and sustainable investing. So a lot of our new assets and strategies that we are managing have a sustainably focused lens. We focus from an investment perspective on 4 things. 1 is research, 2 is shareholder engagement, 3 is thought leadership, and 4 is innovation. So I'll just give a sense on each. From a research perspective, we think, how can we generate outperformance through ESG integrated fundamental and quantitative research? From a shareholder engagement perspective, how can we create shareholder value along with catalyzing positive change? And so we have a shareholder engagement team that works with firms constructively to do that. From a thought leadership perspective, we work with Tonsi at NYU, other academics, and a lot of industry leading networks to both inform our research and engagement process, and we've won some awards for that work. And then innovation, we are building new strategies, and we could talk about that, but maybe that's not a conversation for today. So a little longer than I wanted, but that's what we do, and that's our areas of focus. How is the second portion, the ESG world, changing? We're seeing, especially out of Europe, where we are generating all of the majority of our new growth in assets. And look, 80% of flows are from Europe. 80% of sustainable assets are in Europe. This area is undoubtedly leading the world. That's where we're seeing our growth as well. And what we're seeing is a lot of European leaders setting up asset allocations around ESG leaders, ESG improvers, and thematic strategies. So leaders being, are you best in class, worst in class? Improvers focused on trajectory, are you improving or declining? And then thematic is focused on a main theme like diversity, equity, inclusion, or climate change. One common thread amongst Rockefeller Asset Management, our strategies, is we believe that the world will demarcate more between leaders and improvers. And we see uncorrelated alpha potential or excess return potential by focusing on firms that are improving their overall ESG trajectory. And we could talk a little more about that. So that's how we think the world is changing. We also just published, I wrote a sustainable annual report. And if anyone's interested, we just talked about 5 overlooked trends. So again, when you think about how the world is changing, our 5 trends or allocators are integrating ESG improvers more in value strategies. 2 is food and agriculture is becoming a widely recognized mega trend. 3, we see more sustainable investors that are considering mining strategies, and we can talk about that. 4 is around the importance of climate change, and 5 is we're seeing more and more people talk about the drawbacks of divesting, and we believe that'll receive increased media attention. Lastly, hopefully I'm not going too long for you, Tansi, but you asked what upcoming generation of investors are going to be looking for in 10K filings or annual reports. That's simple. It's four things. It's improved quality, improved timeliness, improved comparability, and the linkage to financial statements. So how do we provide better insights into how climate-related impacts affect enterprise value? So we're looking for quality, timeliness, comparability, and linkage to financial statements and enterprise value.
Thank you so much, Casey. Really helpful. Let me turn to you, Beatrice, from your perspective at BlackRock.
Sure. Thanks, Tansi. And thanks, Casey. Much of what you described is quite similar for us as well. I'll start just by setting a little bit of context for those of you that might not be familiar with BlackRock. We're a globally diversified asset manager, really investing across the spectrum of both index managed portfolios to actively managed public markets portfolios, also to the private markets, and across asset classes, so equities, fixed income, real estate, private equity, et cetera. As a whole, our asset management business manages around $9 trillion of assets under management as of Q1 of 2022. And our sustainable investing portfolio is around $460 billion, again, as of Q1. And so I'm going to kind of shift a little bit and talk a little bit and expand a little bit more on what Tansi started with around kind of ESG insights and principles, and really what this is rooted in and what BlackRock has articulated over the years more recently is that our investment conviction is that sustainability risk is investment risk. So we approach this through integrating ESG insights into our investment analysis and decision-making process, and ultimately we do this through research, tools, and analysis. And our main tenets of ESG integration is first that the information around ESG is really just an additional set of inputs that we take into account alongside traditional financial metrics when we evaluate companies. And what's really important to underscore, secondly, is that we focus on our investment process and on investment value, not values. Again, kind of really underscoring some of Tansi's opening remarks. And I want to kind of emphasize that we really see this type of investing is applicable to our full set of portfolios. So on the one hand, we use ESG insights and incorporate that type of research to build sustainable portfolios, or in other words, portfolios that are trying to meet some sort of specific sustainable objective. But we also feel that this information is useful even for traditionally managed portfolios, because ultimately we believe that companies that have strong profiles on material sustainability issues will outperform those with poor profiles. So we believe that companies that manage with a focus on sustainability will be better positioned versus their less sustainable peers to weather downturns and still benefit from a positive market environment. And I guess from like kind of the what's changing aspect of the question, our investment thesis on sustainable investing is primarily based really on kind of two parts. The first is that we believe asset prices and portfolio risks don't yet fully reflect the broad set of sustainability related considerations. And then we kind of further categorize those into three buckets. The first are the impacts associated with the transition to a low carbon economy. So in other words, kind of consumer preferences changing or the regulatory impact on the demand for fossil fuels. A second category that we look at are the physical impacts due to climate change. So you can think about this as the impact of rising temperatures and how that will impact agriculture or labor productivity, or how the impact of extreme weather events might impact fixed structures like real assets or local economies. And then the third category that we looked at is a bit more broad ranging, and we kind of focus on both positive and negative factors that are usually non-financial that might impact an issuer's operational effectiveness, its public perception, or its social license to operate. And so the kind of second part of our investment thesis is that society is more and more aware of these trends towards sustainability, and that in and of itself is causing a large reallocation of capital towards sustainable investing. And that's creating kind of a flow of capital towards those companies with positive sustainability characteristics and away from those with negative ones. So for us as investors, we kind of see that this growing attention on the topic of sustainability is kind of attracting flows, but also impacting the returns of sustainable assets or companies. So when we think about investing with ESG in mind, it's not necessarily to change the portfolio objectives. We, as asset managers, act as a fiduciary to our clients, really seeking to achieve long-term performance impact. And we kind of see sustainability as a long-term driver of managing risk-adjusted returns. When we think about disclosures, we focus on a combination of both third-party data and analysis that comes to us through data providers, but then we also do our own research on companies. So the more and more companies disclose and disclose consistently through voluntary frameworks like the TCFD or the Task Force for Climate-Related Financial Disclosures, or the TNFD, which is kind of just an emerging area for the Task Force for Nature-Related Financial Disclosures, or also in financial reporting, we can use that information in our investment decision-making. So we really support disclosures. And the reason for that support is kind of really rooted in the need for us to be able to compare the consistency of those disclosures of companies in the same sector. I'll stop there for now.
Thank you so much, Beatrice. Very helpful. So let me turn to you, June. Now, you're a bit different in that you are an actual asset owner, right? And you're finding asset managers that meet your objectives. So I wonder if you could share with us a bit about your own church pension funds focus on ESG, what you see as important there, and also because your background is specifically around things like forest products, if you might want to share with us as well what your perspective is on that industry in terms of their reporting on ESG, what are the material issues you're concerned about, et cetera.
Absolutely, Tansi, thank you. Yes, the Church Pension Fund is, for those who don't know, is the benefits organization for the Episcopal Church. I always say it's quite old, so they grabbed the name church. The Episcopal Church grabbed the church very early, but it is the Episcopal Church, mostly here in the US, but in the Americas. And we currently manage around $17 billion in assets. As a pension fund, and particularly as a US pension fund, it's very different than in Europe. So you should take that with a grain of salt, because the Europeans, I think, are in a very different place right now in terms of institutional investing and ESG. But in terms of for US pension funds, we really have to and choose to need to believe that all of our investments are gaining a market rate. We are very interested in adding to ESG, but we are not, and when I want to say supposed to, it's not just regulation. I always say our constituency are not wealthy people, so we really do want to be sure that everything we do is protecting their long-term assets. Having said that, I have never ever been someone who believed that this is a either or proposition. I've never found that to be it's a interesting challenge sometimes, but it's no different than a challenge of finding any other investment manager or investment vehicle. And it's always been seemed clear to me that focusing on some of these areas that investors and consumers and regulators are increasingly interested in is actually completely consistent with looking for a long-term return. And for our portfolio, I think we have generally found that to be true. I agree with Beatrice that we are seeing more and more flows to this area, which are nice for our for assets that we've held for many years, because we are seeing a nice tailwind, which is always great. So what do we see? For one, I want to say, and it's good that Casey and Beatrice went first, because of course the ways in which they look at investing and the ways that they want to understand, they then report. Asset managers then report to us. So we're one step back from that, and we're going to, in the same way that asset managers want to hold companies accountable and understand better where these issues affect their businesses and how they are treating that. We want to understand how our portfolios are doing that, and in the same way, we want to managing it, counting it, all of these things collectively. So again, we're one step back. I think as our constituency are a large, diverse group of people all over the country and in other places, and then on top of that, we have our board. I think what we look for are first, and almost always first, is headline risk, right? We would never ever want a priest in anywhere, or anybody, nobody wants this for their pensioners, to read a paper and say, the Episcopal Church has funded this thing, which has put, a First Nation out of their homes, or has, caused terrible harm. So we're always gonna to be very focused on that, and want our managers to be thinking of doing that right thing first, because of that risk, and also because this is what our people who hire us ask us to do. But I also think for me and for my ability to both choose a manager and to actually bring that manager completely through our approval process, I really do want to understand how they're looking at these areas and how that is causing them to drive returns on my level. So how is an asset manager using some of these trends to actually find attractive investment opportunities? And again, I do want to stress, this is not it has never been an either or proposition. It is certainly not an either or proposition these days. I think to the extent people are thinking that, they're being naive. In terms of, and yes, my portfolio, I do have a very odd portfolio. It holds some of our legacy resources. So some of the tougher stuff, like our early days of oil and gas and metals and mining, some of the things that that some of our constituencies have more issues with, but it also does hold our sustainable agriculture, sustainable timber, and it's a very interesting time in this area. I've been doing this a long time, and I remember 20 years ago or so, when Harvard and Yale, that was probably like 5-10 years after Harvard and Yale had started this trend, and people were looking to that of American timber, and it's been, and a lot of the institutions were holding that. We hold them as well. The return has been a little bit different than we expected, let's say, for all sorts of reasons. I think we are coming back again around to a time in which institutions will be looking to this industry. I think it is interesting to me that when I tell people we hold timber, oftentimes I get this look where people will imagine a movie they've seen 20 years ago with clear cutting and damage, and I think it's quite interesting, because as an industry, of course, it is such a natural fit for sustainability, for what people want to see. And so I would say that the asset management industry in general in this area, and also these companies, they really need to elevate that conversation and that understanding that this is not an industry in which people need to feel concerned about, gee, what about ESG? What about climate change? How are you helping? But to help people to understand that this is a very natural fit for their desires and their concerns in climate change and being good citizens, good neighbors, and all of that. So yes, I'll stop there. I don't know if that was clear, but.
No, it was very helpful, June. Thank you. And I agree. I think that focus on sustainable forestry and how it can support overall goals around climate makes a good transition over to Sophie. Sophie, would love to hear from your perspective as someone who's from the forest products company who is dealing with investors on these topics. How do you see this sort of the sustainability issues coming to the fore in terms of investor relations, and what are you hearing from them in terms of what they want to hear you focus on?
Yeah, great. June set me up perfectly. So thank you so much for the segue on that. And there's so many great issues that we could sort of unpack. I think that some of the previous comments have been really helpful in just kind of thinking through this. First of all, I would say International Paper, for those who don't know us, we're a packaging and pulp company. So we do produce the boxes that you see arriving on your doorstep, and lots of pulp for hygiene products. And those products travel around the world to kind of meet everyday needs. We really think about sustainability not as sort of a strategy that layers on what we do day to day, but rather looking at our business model as one that can deliver sustainable outcomes. And Tansi, I think this gets to your original point about how are we embedding sustainability in the day-to-day activities and operations of our businesses, so that we can truly look at kind of an integrated approach that's delivering those outcomes without it having to be a tick box exercise after we get through our day-to-day work. So I think that's kind of the starting point for International Paper. What I find really interesting about this ESG conversation is that we have been working for decades. We're in our sort of second decade of concrete environmental and social goals and targets and we're aiming towards 2030 to deliver on some of the commitments that we've made. But we have been talking to ourselves and each other and those who are interested in this space about stewardship and about the work that we really do in stewardship, both for people and planet. What we now have to do is say, how do we translate stewardship into some of this ESG vocabulary? And I would completely agree with you, Tansi, that I am sort of opposed to the notion that we would let the ESG criteria set our